Rob, what's up, man? How's it going?
Hey, nice to see you. I'm doing well.
How's New York treating you?
Treating me very well. It's actually a rainy day today, so it's we've been pretty lucky with some warm weather this late in the year, and so but I think now it's finally changing.
Cool, cool. You're looking sharp. You're looking all Harvey Specter on me, man. Come on.
Yeah, well, it's New York, and it's what I
Yeah,
like to do.
there you go. There you go. Listen, man. So yeah, I was very much looking forward to this conversation. I think this is going to be a very very exciting one for people to hear and extract some real value out of it. Um, if by the way, if you're not part of Rob's email list, you should be there because that's what sparked this idea of us jumping on the call, which basically is to talk about a few things here and there, but the main focus we want to talk today about is the dual tranche or dual equity syndication structure that many sponsors are using today, which to me I like it. My investors seem to like it a lot as well. So, and I've been getting a few questions about how it actually works, who is getting the benefits, and why are you even doing it? So there's a lot of questions around it because it's basically a real creative way to structure a deal to accommodate different types of investors and whatnot. So first of all, man, thank you for being here today.
Yeah, thanks for reaching out and making this happen.
Cool, man. Cool. I guess quick overview of who's Rob. I guess let's start there. 1 minute pitch of your company or yourself. Go for it.
Yeah, so my name is Rob Beardsley, founder and principal of Lone Star Capital. We invest in value add multifamily B and C class in secondary markets of Texas, focusing on we really like the Houston MSA, but we're focusing on other maybe overlooked markets that still exhibit the strong growth that Texas as a whole has. So that's in a nutshell who we are.
Cool, man. Cool. Good stuff. You've done quite a few deals by now. You're closing on a few of them. Very exciting stuff. And so yeah, I guess let's get into it.
Dive in.
Yeah. By the way, for those of you who don't know who I am, Lennon here, the multifamily investor. Same as Rob. I'm a full-time multifamily investor. We buy apartment complexes. We're specifically focused in Florida, but more specifically in the Jacksonville market. That's the market that we like. Right now, our current focus, it's a mid-size, that's 50 units or more multifamily in that market. And the same thing, you guys do a little bit more of a heavy value add, or you're actually looking for that, whereas we are actually more focused on lighter value add plays, a little bit more stable properties. But ultimately, we buy and acquire these properties in partnership with accredited investors. We raise equity from them, and we reap the rewards of doing these big deals together. That we couldn't do them otherwise, right? So that's kind of the idea of this whole syndication game. So that's what we do. The company's BLD Capital Group, and yes, so that's that. Let's go. Let's get into it, man. I was before starting the recording, I was asking you about the adjustments that you've made since you started to your investment criteria and the underwriting as well. How has that changed, just in general, but then also looking forward to, well, maybe not looking forward to it, but moving
Yeah.
into a potential recession.
Yeah, so something that I've always been really interested by are stress tests and different scenarios and sensitivity analyses. And so I think with people being concerned about the future prospects of deals, whether that be rent growth not being where they thought it would be or cap rates expanding on exit, those are all risks that we want to underwrite, analyze, and see if they are overcomable. And so the thing I say a lot about now is, the returns are getting tighter,
Yeah.
the risks are higher, right? And I think the best thing that you can do for yourself. So number one, if you underwrite conservatively and you say, all right, well, just in case we have a really bad scenario where cap rates go up 150 basis points and rent growth goes negative, like if you underwrite that in your model, you will never buy a deal because you'll be there bidding against people that think rents are growing to the moon and cap rates are compressing still, right? You'll never outbid those people. So when you're bidding on deals, you still have to be competitive with your underwriting. So you need to find the right places to get aggressive and find the right places to be conservative in your underwriting to make sure that number one, you're competitive enough to actually win deals, but number two, don't lose money.
Right. Because I've never heard someone say, well, you know what, I underwrite very aggressively. So everyone, like no one is out there saying that they don't underwrite conservatively. So let's get real, right? Let's get real, because if you're getting deals today, you're probably not being as
aggressive,
conservative that as you probably think you are, or saying you are anyway, right?
Right. Which, I mean, that doesn't mean that's not a bad thing. Yeah, it doesn't mean you're a dumb investor or it's a bad idea to be buying deals right now. You have to be buying deals at all parts in the cycle, because what we do is we're in the capital allocation business. And at the end of the day, if you, for example, or I, for example, let's say I sold a company or I got an inheritance or something and I had a bunch of money and I had to invest it today, because if I didn't, that money is going to sit in cash and erode. Right. What am I going to do with it today? And so if you look around the world and you say stocks, bonds, real estate, private equity, venture capital, I mean, real estate on a risk adjusted basis, the things it offers with tax benefit is still such a good place to invest, but we just have to be smart about it and not get ourselves in trouble with these high valuations.
Right. So because what's the alternative, right? Like I always get asked these questions about, well, yeah, we're at the top of the market. We're definitely at the top of the market, right? It just doesn't, just don't know how long we're going to stay here. But ultimately it's about the long-term perspective as well, and understanding, just like you said it beautifully, we're on the capital allocation business. Ultimately, what's the alternative? Yes, you need to take a hit in terms of the returns compared to, let's say, 2014 or 15 returns, right? Where you're getting 14, 15% cash on cash. Right now, 7%, it's healthy
It's okay.
You know, it's very healthy. And people are going to say, well, you know what? I'm used to getting 15%. Now I'm not going to invest anymore because it's dangerous, whatever. Okay, so what are you going to do? Are you going to sit in the bank and lose money, or where are you going? So I think it's having that long-term perspective, right? And looking back and saying, well, if I average out all of my investments in the past, let's say 20 years or 15 or 10, then if they look okay, then they look okay. You're doing a good job, right? It's not about timing the market, I think.
Definitely not timing the market. And so you asked me, you know, before we started, and we'll get into a little bit now before we actually dive into the dual tranche, is, you know, how does my strategy change right now? And I think, you know, one of the best strategies you could do right now is really buying deals that you feel comfortable owning for 10 years. And a lot of people hate the idea of owning anything for 10 years, right? That's a long-term commitment. And we're not interested much in that either. And that's not our goal. But if you can focus on buying deals that you would be comfortable owning for that period of time, then that puts you in a really great situation to make it through a recession and actually see a positive return on your deal, because over time, that if you bought the right deal, we're in the right place, you will see that rent growth come back, and you'll see the healthy fundamentals return if they go sideways in a recession. So for like you mentioned, you're a bit on the lighter value add, which pairs well with long-term fixed rate debt for 10 years. We are a little more unique because we still are pursuing deals that have more risk, that are hairier. And for us, I think it's a different strategy that I'll admit isn't necessarily the best for where we are in the cycle, but we think that there's just so many people that are seeking that protection in the lighter value add that actually we can pick up some additional generous returns on the heavier stuff. So it's just, what's your risk? And
I think that's the question. We always, I'm sure you always get asked this question from investors as well. Like, well, what's the better strategy? What should I do? Well, there's no answer. There's no straight answer for that, because actually your strategy might be the best strategy for an investor that's at a different point in their investment career, or even in life, or whatever, or financial situation in general, and they're able to take more risk. And that strategy, it's the best strategy for them, versus, for my investors, it might be a little bit different or whatnot. So I don't think there's any best or right or wrong, on it.
Right. Yeah. But late cycle, buying deals, you can't go wrong with buying deals where the cap rate is 150 basis points greater than the cost of your debt, and if you have 10-year money. If you're in a situation like that, that is a winner at this point in the cycle. It may not be the sexiest deal out there, but that is what is a good deal today. So where you see people getting into trouble is, they're making deals look decent based on interest only. I'm not saying interest only is bad, but just it makes the cash flows better, and some people don't understand the difference. But
Right.
if you at the end of the day, if you're buying a deal at a 4.5 cap and your debt costs 4.5%, when amortization kicks in, your cash flows are going to go down a bunch. So, finding deals where you can still get that spread, that's a good deal.
Cool. Yeah, that's interesting. And by the way, that conversation, we're gonna have to meet again sometime next week or whenever, to talk about the long-term debt versus the bridge debt, how bridge loans are not necessarily as evil as people think they are. And again, this is a little bit above my pay grade. You're very good at this, so I'm gonna let you educate these guys on that front. But that's a
fun one.
That's a fun one. That's a different conversation that we can set up. So what about that? Like specifically on the underwriting, before we move on, how have you adjusted the way you underwrite the deals, and not only from the debt side, but maybe what assumptions are you making,
right?
And, that type of thing.
So, actually, this is an interesting take, but I think. So rewind to 2018, middle of 2018. If you looked at the implied futures market for interest rates, as well as the LIBOR forward curve, everything was pointing towards higher interest rates, right? You were there, all the talks of rate hikes and lock your debt now, you're a fool if you're floating, and all this stuff. And back then I was underwriting to higher exit cap rates, because it's pretty logical. If you have higher debt, then your exit cap rate should be higher.
Right.
And so now we've really seen the forward curves for all of interest rates, short-term interest rates, long-term interest rates, they've all really cooled off and are actually going lower.
Yeah.
So at this point, I feel more comfortable underwriting to lower exit cap rates, but also being more so that makes me more aggressive. But being more conservative on rent growth, and maybe vacancy numbers, or so operating projections. So basically what that allows me to do is, with a lower exit cap rate, I can be more competitive on my price, because I'm projecting a higher sale price, and so I can get a higher return. But to combat that, I'm more conservative with my fundamentals and my growth assumptions. So that's something that I've tweaked over the last year maybe. And then I think something that's very recent, something that I've been learning just through talking to a lot of people, and we're experiencing this as we're looking at our own portfolio, it is people buy deals with 10-year loans, and they'll say, hey, we'll sell in 5 years. Right. It's like, well, you have yield maintenance, right? Typically, or defeasance, and that can make it tougher to sell, not impossible, but I think the conservative thing to do is to underwrite to, if you're going to say, well, we'll sell it on assumption, you typically have to take a discount for that. Right. So you should underwrite to a higher exit cap rate. If your business plan is to sell in 5 years, but you have 10-year debt on it, right, that's kind of a really nuanced specific thing, but that's something that if I were an investor, I would be asking my sponsors and saying, okay, you're putting 10-year debt on the deal. What's your exit strategy? And I would want to hear if they have the right answers to that question, because that can be a tricky one.
Yeah, that's very interesting. That's a very interesting one. I don't think any, well, not any, but I don't think many investors out there are asking that type of questions. and a lot of it is yes, because I was having this conversation yesterday with someone saying actually when you're a limited partner, that's what you want to be. You're a passive investor. A lot of these guys, they don't want to know, like they don't care, right? But they should.
Right.
But they should. That's the point. So
Yeah.
a lot of education and a lot of knowledge that you need to consume in order to be prepared to be a passive investor. You know, let alone
A lot of work.
an active one, right? But be a passive investor. You need to know what you're doing just so you can ask the right questions. So yeah, that's great. So okay, man, let's I like that conversation. We're gonna have that conversation another day, because I also like to talk about how people don't understand that really, if you're buying a property and you're repositioning it and making it a better property, you are potentially or actually by definition you are decreasing the risk. So by definition, your cap rate at the exit should be, maybe you bought a class C property and you transition into a class B property, your exit cap rate should be a class B exit cap rate versus the cap rate that you went in. So, but yeah, you want to be conservative. So, but where do you draw the line? That's kind of the debate. I think that's interesting to have. But anyway, so the dual equity, the dual tranche, as you call it, syndication structure. What is it, and what's going on with it, and what's your take on it?
Yeah, let's run through that. So just to explain to everybody who isn't familiar, but I'm assuming some people have already seen this and maybe wondering, what is this? How does this work? What does it mean? So just to overview, what I call is the dual tranche syndication structure, or you could call it, Class A, Class B. But typically, what it means is there's two different groups of investors for a deal, and one group, call it the Class A members, they receive a fixed 10% return, and they get no upside in the deal, but they get some security in that 10%, in that it's preferred before the Class B members receive any return. Now, of course, there's a million different ways you could structure deals, so this is just one example, but
Yeah.
this I think is a pretty standard one. So then the Class B would get the cash flows after the 10% got its return, and then upon sale, the Class B gets all the profits. It doesn't have to split it with the Class A shares. So it's an interesting.
They have to split it. They have to split it with the GP or the Class C, if you will, but not with the Class A, right? So
exactly.
So have upside there.
Yeah. So it's and the way the GP works in this structure is also really interesting, because when you're effectively using leverage by leveraging this fixed rate of return from the Class A shares. So that leverage means that the Class B members get a higher IRR typically. But what's interesting about that is the GPs don't get a higher return. So it actually works out that usually the GPs get a lower return, because if you think about it, let's say a deal has $1 million profit.
Right.
The Class B members don't have to share that profit with the Class A, but the GP is still going to get its 20 to 30% of that $1 million, regardless of the dual tranche or single tranche structure.
Right.
So it's actually an interesting thing that the GPs that are putting this structure together most likely are actually making less money in this structure, but they're doing it to make it a more compelling investment for both cash flow investors and total return investors.
Right. So it's not a creative strategy from the GP and the sponsors now to make more money or anything at this point in the market, right? So why don't you let's dive a little bit deeper into it. I know you have a couple of tables there that you can share with us. So why don't we have you share your screen, and then you can talk about it. There you go.
Sounds good. Yeah. Cool. So we've got a hypothetical deal here with purchase price of 10 million. These numbers this is not a real underwriting. These numbers have gotten all mixed up over a few different examples. So if you see something that doesn't make sense, that's why. So don't hold me to it. But we're looking at this deal here, and we see LP IRR of 13.9%. So right at 14, with actually a pretty strong cash on cash of 9.5. So this is this is a good deal. Um, but if you want to get creative and push the total returns, let's say you're not, as a GP, you're not confident that 14% is really going to get your investors that excited about a total return.
Right.
So what we can do here is we can split it up and we can create this dual tranche structure. So this here is where I'm going to input the assumptions to create a preferred equity or A share tranche. So I turn it on. It's going to be about 15% LTV. We can break it down how that's going to break, but if that's going to make up maybe 35 to 40% of the equity.
Got it.
And then 10% interest rate, that's their preferred return, that they're getting fixed payments. They get no upside. It's not amortized and there's no fee on it. They just get their money back upon sale.
Got it.
So we jump over here and the IRR jumped to 17.2. Now that is exciting, right? Yeah, so that could make an investor pretty excited. And because the cash flows were 9.5 before, I think they were 9.7 maybe.
Yeah.
The cash flows didn't change very much. But what you'll see, and we'll show an example in a second, when the cash flows are light, let's say the average is 8 or 7,
right,
putting this 10% A tranche in there will really hurt it. So first, I just wanted to show how doing this splits it up, and this the IRR goes up, and that's because the investors on the B side are getting all the A's upside on the sale, right?
Right.
Okay, so we'll just dive back and go ahead.
Combination, right? Because right now, that's what typically happens. Just like you said, that when the cash on cash is not quite up there, then it gets hurt a little bit more significantly for the Class B. But it's about balancing the whole thing, right? Like, okay, well, now you have investors that can have a higher cash on cash on the Class A side, preferred position. They get paid first, and they have let's say that 10%, right? But now on the Class B side, you're in a second position. Your IRR and your overall returns may be 17%, which is nice,
really
very
awesome.
But your cash on cash, where on a different structure you would have, let's say, 8% pref. Maybe your pref it's now going to be 7, and your average it's going to be somewhere around 8 or maybe below 8. So but it again, it's you can't have like everyone cannot have what they want at the same time. That's
right.
So I
think, to illustrate that a bit more, I turned up the vacancy to 10% from 6%. So now our cash flows are going to be worse.
Right.
And so I'll show. So let me turn this off now, and we'll just show these baseline returns. So now it's 8.3%, right? And so this 8.3% is not bad. Most deals right now, if you're buying in a good area, 8.3%, that's a great return on your cash on cash, right? So, but unfortunately, when you put the 10% there, that 8.3 is now down to 7.1, because basically the A shares with the 10% are stealing money away from the B on an ongoing basis. But the IRR, like we talked about in that previous example, goes up. So like you said, it caters to an investor with different goals. Right. And it's a nice way, and I think it's an efficient way to structure a deal to give both groups what they want. So I think the one, like jumping into a couple nuances, one thing that investors should understand about this is the leverage component. Mm-hmm. This, like if I quickly set it back to where we had it, where it's a beautiful 17% return. That return, you have to understand where it's coming from. You have to understand that is a return that is generated by leverage. So because you're leveraging behind the A shares. So on a risk-adjusted basis, you're taking higher risk, but you're getting that higher return. So as an investor, you have to weigh whether it makes sense for you and whether you're comfortable with the risk. It's not like you can't compare apples to apples. In a dual tranche structure, you can't say, well, I'm getting a 15% return on this dual tranche deal, or I could invest in the same deal with no dual tranche and it's 15%, right? You'd obviously want to take the deal without it.
Right.
Just because it's lower. So investors should understand that, they should be comfortable with what they're getting into and understand that this isn't just, two different options, that there's actually leverage implications. So I think that's something that's not as often talked about, that, hey, the reason why the A side is so nice is because, if we're looking at it like this,
Yeah.
you've got, 50 to 75% of the equity as a cushion, ensuring that you get that 10%.
Right.
Like if I jump over here, this 10% represents 150,000, right?
Right.
And if I don't have this set up, but if I quickly take the, do you see my spotlight?
Yes, I do.
Oh, nice. So if I take the NOI, which is right here, just call it 677,500,
Yeah.
and I subtract it by the asset management fee, and then subtract it by, the debt service, 354,000, right? So now this is the free cash flow we have to pay the A shares with,
Hmm.
right, which is 150,000. So this is a debt service coverage ratio based on the A shares position in the capital structure. So this is a 1.96 cover, which is it's a great coverage ratio. So you're able to, basically what could happen is you could see a 50% reduction in your free cash flow, and the A shares would still get that 10%.
Yeah. Yeah.
That is comforting, right?
Definitely.
So let me ask you a question before we dive into the next part. Have you had an easier time teaching your investors, and where have your investors been more interested, in the A or the B?
We've I would say 50-50, and yeah, I would say 50-50. But they definitely, like the ones that were interested in the Class A were very, very excited about it. Like, because
Yeah.
it was like, okay, that's what I was waiting for at this point in the market. And even if they don't understand the whole, picture, maybe like you do and like I do, they do understand, like, that, what they're doing, of course. And this was a very good product to put in front of them. We recently did a deal with this structure, and it was very attractive. Um, I'm not sure if it would have been filled up, like the Class A side, if it would have filled up uh, as quickly if the Class A equity would have been, let's say, 50%, because in our case it was 25%. Uh,
Right.
but that 25%, that, what the first commitments I had was on the Class A, and then we started filling out the Class B side. So yeah, it was good feedback for sure.
Yeah. So that's a really interesting thing, and I wanted to. That's a good transition to talk about the leverage point, right? And so,
Yeah.
what is the appropriate what is the appropriate balance between the A and the B? And so, like you said, there was a 75% B, 25% A.
Yeah.
In my opinion, I think that is really generous to the A, and really puts it in a great safe position, because we looked at this deal where it's 1.7 million B, 1.5 million A, so it's about maybe 45%.
Yeah.
So, and we're still getting nearly a 2%, I'm sorry, a 2x cover.
Right.
So if I tweak that down, right, it would be even higher. So in my opinion, I think a better way to structure these deals is to try to get it as close to 50-50 as the deal allows. The issue is, and the reason why for a lot of deals can't do that, is just the cash flows on the B side will get too low.
Too low, right.
Right. And so that is the balance. So if you can find a deal, obviously more cash flow is better in all situations,
Right.
but especially here when you're chopping it up, the higher the cash flow, the better. And I actually want to show a really interesting scenario.
Yes.
Where, let's say you're able to steal this deal, right? And you're able to buy it for 9 million,
Right.
which in this scenario would be a great deal. So let me turn off the pref structure. And now we're just buying the deal, regular syndication. So as you can see, this deal has double-digit returns for every year, even when the interest only payments go away. So here you're paying interest only, and then you start amortizing. That's why it drops.
Yeah.
But you're still over 10%. So your average is 11.7. So in this case, the project level returns are higher than the Class A 10%. So if we were to layer in this Class A at 10%, Now the Class B won't go lower, it'll be higher. So we went from 11 to 13.6.
Right.
And you can see the return just goes crazy. So
Yeah.
this structure would be very interesting to put on a deal that already has a lot of juice.
Yeah.
The thing I wonder though is, would the conservative investors in the A side still be comfortable knowing that the B side has these high projected returns, that
Right.
they can get higher average cash on cash
Yeah.
and higher returns, total returns?
Yeah.
Are they willing to trade that safety away, or take that for safety?
Yeah. Well, that's an awesome question that we can leave them to think about. But because yeah, it's gonna be interesting, right? Like, well, what do you want? Like, you want to be in a preferred position. Like, these guys are getting paid. Like, if something goes wrong, which obviously it shouldn't, but if it does, then you're not gonna get paid first. So again, it's not for everyone. A lot of my investors were asking just that, right? Like, hey, but you know, I don't want to be in a Class B. I mean, I want the upside, but I mean, now I have someone in front of me, basically like a preferred equity, which
Yep,
is,
that's
uh,
what it is. Yeah.
and I mean, I don't know if I feel comfortable. And they're like, well, you don't have to. It's not a structure for everyone. I mean, it accommodates different angles. Yes, the risk profile on a typical syndication, it's going to be lower than your Class B on a dual tranche, just because, well, you have the preferred position there. But then you still have a preferred position before the Class C or the GP.
Right.
So I mean, it's balancing the whole thing, but I think that all in all, it's definitely very attractive and a good way to think about deals as we look at them, and for investors to understand. Well, maybe you want to do a Class A investment in 2 deals per year, and then do 3 deals with Class B investments and balance your cash flow that way. Or maybe on the same deal, you invest on the Class A and on the Class B, and you start running your numbers to see what makes sense, and to better protect your capital if you want to look at it that way.
Yeah, that's a good point. I guess if you love a deal but you don't love the structure, you could invest in it on both sides to effectively make it a single tranche deal for you.
Right.
That's an interesting point. So
Well,
jumping over onto the GP side, I think this is something really interesting, and it was an aha moment for me when I was first running through this in my mind, and I started modeling different returns, and I thought, wait, I made a mistake, or what's going wrong here? My initial thought was, well, hey, if we are using the leverage of the preferred equity on the A side to get higher returns, shouldn't the GP get higher returns? And that, I think we talked about that earlier. So I
yeah.
just wanted to actually show that here, and this is my GP tab here, and you can see because we don't have the dual tranche structure on, we have higher cash on cash, and the you can see the promote is being earned every year,
Yeah.
and then on sale we've got a nice big sale promote, which is 30% of the sale profits.
Right.
Now when I put on the preferred, you can see the cash flow went down, and then it actually disappeared once it started amortizing. So the cash flows dipped so low that preferred on the B side couldn't even be hit. So the GPs are taking a hit
Yeah.
on the GP compensation, but as you can see, the sale didn't change.
Yeah. Yeah.
So I think this is a really interesting thing that the GP, will potentially make less unless they adjust their pref. They'll make less on the promotes. They'll still make the same amount, not more, but just the same amount on the sale, assuming that they're current and paid on their pref. But I
Yeah.
thought this was an interesting thing for GPs to be aware of, because if you bought a deal with really tight numbers,
Yeah.
and then as a GP you wanted to put this on to really give it some more juice, you might be not making much money on the deal.
Yeah. Yeah. This is great actually, because like we talked, right, like now, and if you start thinking about it, it gets in a more intuitive way, then you kind of see it, right? Because okay, well, now you have a 10% preferred that you need to pay no matter what.
Yeah.
That's eating into the Class B, but then it's also obviously eating into what whatever you were going to get from that cash flow, which again, at this point in the market, it's typically going to be very, very tight anyways for the GP. If you even see anything from the cash flow on the any year.
On the promote, yeah, absolutely. Exactly.
So, but still, right, in a deal like this one, where you did have a healthy GP cash flow from your promote, now you don't necessarily have it. But is that going to allow you to raise more capital? Is that going to allow you to raise capital more efficiently, build new relationships with investors that maybe they were not interested in your deals before, but now that you have that preferred equity position, they are. That's a new relationship. That you can't necessarily quantify initially anyway, but those relationships and that potential of serving the investor first, or that mindset really of serving the investors first, it should pay off in the long run, right?
Agreed. And I mean, especially, and I'd say maybe not, maybe even more than especially, but only if you're really buying deals in the best interest of investors, and that you're actually not just buying deals for fees, and that you understand that deals are tight, but you still are providing good opportunities to investors and protecting their capital. And that way, if we do see a period of time where returns become a bit more generous, they'll be there with you, ready to buy those deals, and you'll be able to earn a bigger promote and all that good stuff.
Yes.
Yeah, I agree with you 100%.
Listen, man, this has been great. I think this is very enlightening, and it's going to help a lot of people out there understand it. Maybe we're going to have at least one or two more conversations around this topic. But I like the structure. I think it's an alternative. It's creative, and again, it's going to allow us as GPs and sponsors to cultivate potentially better relationships or new relationships with potential investors, and ultimately the investors get the ability to go into a deal with different, like they have the option, right? Not before, they didn't have, they only had one option. Now you can make it work for them.
I'm with you 100%. It's a more efficient capital structure that caters to various needs of investors.
Cool, man. Well, there you have it, guys. Listen, man, thank you a lot. This has been great. We have that other conversation pending then
Let's do it.
We'll set it up, but that's going to be an interesting one, a little bit more sophisticated. Again, above my pay grade. That's why I'm going to have you explain it to me and to everyone. And I guess I'll see you on the next one, man.
All right. Thanks for having me.
How can people reach out to you if they want to learn more about what you're thinking about the structure or anything in real?
Absolutely. Yeah. So like you mentioned early on, my newsletters, where I do a lot of my thinking and writing, I try to put out really deep, insightful content that's coming at me from actually being in the business day in and day out. So that's once a month, and you can sign up for that newsletter at LoneStarCapGroup.com, and you can email me directly at rob@LoneStarCapGroup.com. People often reach out for my underwriting model package, and I've got some other resources to share. So, reach out and let's start the conversation.
Well, there you have it, guys. Lennon Lee here. You can find me on I'm super active on Instagram, on all the social media platforms as well. And if you want to download a passive investing in multifamily ebook that I have, go to boldcapitalgroup.com/join. I also have a newsletter where I share not as sophisticated content as Rob, but definitely some nice articles about the way we look at our deals and what's happening in the industry in general. So thank you for having us, and we'll see you on the next one.